Brazil is quite an aggressive tax jurisdiction, municipality and all sort of taxes. According to the reading materials, the country has its own CFC, controlled foreign company rules, which makes doing business in Brazil even more burdensome. Can you please clarify if there's any movement for universal CFC rules that aims not only to impose anti-avoidance rules, but also to encourage a more favorable business environment in certain jurisdictions? Just so you know, these answers will also be shared afterwards. So let's start with the first part of that question, and that is the simple answer is yes. There have been discussions and proposals at the international level regarding universal CFC rules, and those are there to balance the anti-avoidance objectives with a more business-friendly tax environment, as that's always the challenge. You know, it also prohibits businesses, once they start adding up everything, they start realizing that the tax is going to be quite burdensome, and it's quite challenging to go and establish a business in another jurisdiction. So achieving this uniformity across jurisdictions remains a challenge due to the differences in tax policy priorities if one goes from a country to country basis and starts analyzing them. So the OECD and the BEPS action number 3, which specifically refers also to CFC rules, and you'll all remember the BEPS action refers to base erosion and profit shifting. Action number 3 proposed a coherent framework for CFC rules. Now, the OECD recommends that countries adopt strong CFC rules to prevent profit shifting, so that one has got a more universal approach. But this doesn't necessarily mean that you're going to end up with that universal approach. The key recommendations that are included there is that under the BEPS Action 3 is defining the CFC income broadly, in other words, passive versus active income, establishing effective control tests, and then allocating the income according to the good transfer pricing principle of arm's length principle. So Action 3 does not explicitly encourage a pro-business environment. Instead, it focuses on anti-avoidance measures. Remember, the BEPS stands for base erosion and profit shifting, and that's usually in many instances could be seen by business or be frowned upon by business. But that's, as we know, is to balance the tax situation as well. So that's the first thing we need to say. The second thing is regarding the European Union approach. That's balancing the anti-avoidance with competitiveness. So the EU anti-avoidance directive, ATAD, introduced CFC rules as part of a coordinated response to profit shifting within the EU. Now, these rules do impose stricter anti-avoidance measures. They also allow certain exceptions. Substantial economic activity exemptions. So in other words, to prove that you've got a genuine economic activity in a certain jurisdiction, in other words, by means of employees that are employed there locally, physical assets, and then the CFC rules may not apply. And then you have certain thresholds and exemptions where certain EU countries have got these CFC exemptions if the effective taxation in the foreign jurisdiction is above a certain threshold. So, in other words, 50% of the local tax rate. So that's what happens. So this demonstrates an effort to prevent the tax avoidance while maintaining good business competitiveness. But that's not specifically for the EU. When we start looking at the US global intangible low taxed income, which is referred to as GILTI, no pun intended here, regime. So if you go and look at that, this US Tax Cuts and Jobs Act of 2017 introduced GILTI, which applies CFC rules on an international scale. So instead of outright discouraging offshore activities, the US provides a 50% deduction on GILTI income. Remember, I'm referring to that acronym, the US Global Intangible Low Taxed Income Regime. And the second thing is you get a foreign tax credit for taxes paid in foreign jurisdictions. As we know, that's quite universal in most jurisdictions. And then a focus on intangibles, ensuring that active business income is not excessively penalized. Now, this approach ensures the business remains competitive. As you can see, approach, in a certain way similar to the EU, where business remains competitive. Then we come to the fourth aspect, which is now more specifically in terms of the question that was raised, and that's Brazil's aggressive CFC rules. Now, we do recognize and acknowledge that Brazil is one of the strictest CFC regimes in the world, which taxes foreign subsidiaries' profits on an accrual basis. Now, the accrual basis means that irrespective if there's a distribution or cash flow moving, if it accrues to a certain subsidiary or to the holding company, whichever way you look at it, then you could end up paying tax on something that's just accrued, but the money hasn't flowed. So in other words, from a cash flow point of view, it also is quite strenuous on the group's cash flow, on treasury function. Brazil has considered reforming the CFC rules as part of a broader tax reform process, but it remains a jurisdiction that prioritizes aggressive taxation over competitiveness. So one could say that is something that is not in favor of Brazil being used as a jurisdiction of choice, but that's the rule of law in Brazil. Now, is there a move towards universal CFC rules that promote business? Well, there is. There's no current global uniform CFC system, but there are trends towards balancing the anti-avoidance with the BEPS initiative and the OECD with pro-business measures. Now, these include, as we know recently, you've got the OECD Pillar 2 rules, the global minimum tax, but as we know, that's got to do with specific businesses and interests that exist. You've got the relaxation of CFC rules in certain countries. The UK, for example, abolished CFC rules for non-UCOM income of sufficient substance, which plays back to what we discussed just now, and that is that there is a real business operations there. Remember, I mentioned the substantial economic activity exemptions, so that plays important. And then you've got thirdly exemptions based on real economic activity, which is quite important. So in summary, a universal CFC framework does not yet exist, but there is a movement towards aligning the CFC rules with economic substance principles. Certain jurisdictions have introduced CFC regimes that do not completely penalize foreign investments, but Brazil remains one of the most aggressive tax regimes in this specific area of CFCs. So we'll see, and hopefully there will be more of a greater balanced approach in years to come.